Hello, good morning, good afternoon, good evening, everyone. I am Nagarjuna Malampati, founder of Remit2Any. First of all, thank you all for taking time to join us this morning. At Remit2Any, we have always believed that sending money should not just be doing a transaction. It should be much bigger, a gateway to something much more, a financial growth and financial freedom and the long-term impact. That's why we have partnered with InvestMates, a platform that is focused for the wealth management for the NRIs, to bring something truly valuable. Today, it's my absolute pleasure to welcome very special guest, Mr. T. Srikanth Bhagavat. Now, he's the managing director of the Hexagon Wealth, a veteran in the wealth advisory, and most importantly, he's a trusted guide to the families, professionals, and entrepreneurs looking to grow and protect their wealth. But what truly sets him apart is not just his experience, but its philosophy as well. Love all and serve all, that's not just his motto, it's the foundation of how he serves his clients with compassion, sincerity, and deep commitment. And don't worry, this isn't going to be a boring finance lecture. Srikanth has a unique gift. He makes the complex ideas simple, relevant, and real. So without further ado, please join me welcoming Srikanth Bhagavat. Srikanth, over to you.
Thank you, Nag, for that kind introduction. And welcome to all of you. Good morning, whichever part of the world you are in. And I believe we have gentlemen and ladies from across the world here today. Without wasting too much time, I would like to get into the presentation because what we have to say today is very important and critical. Let me get into it. This is a common concern today, I believe. The dilemma facing quite a few, whether NRIs or not. Where does one invest? Where does one save? Is it gold? Is it equities, deposits, or how? And there's been so much chaos out there in the market. I was hoping that in the next few minutes, I would try and clarify a few of these issues for you and maybe give you a solution. Let's see how it goes. But before I really get in, I have to make this disclaimer that this webinar is purely for awareness and education and not investment advice. Okay. And any investment that you may want to do should be done in consultation with your investor, more to share knowledge with you all. Let's look at where we are headed today, the situation as we stand. You've probably been reading about this, hearing about this, the great global reset. And actually, we are living through it. It is not something that I would have expected even a couple of years back, that I would be going through something that history would call the great global reset. And many of you may think that this reset started with the tariff season. I don't think so. This reset started a couple of years ago itself. Okay? The first trigger for the reset was the COVID era, when nations suddenly figured out or came to the understanding that the flow of goods could very easily get disrupted. When China shut down all its borders during the time of COVID, a number of things could not move in and out. Same with other countries that were used to trading goods and services. It was a period of painful realization that and after that, you would be familiar that the China plus one kind of strategy started coming out, that companies should not depend on just one manufacturing source, but should be having multiple manufacturing sources. So the China plus one strategy really went out and gave opportunity to many countries to improve their manufacturing potential. That was the first step. The second step happened in 2022 when the Russia-Ukraine conflict broke out, and the US decided to freeze Russian assets. And then Europe also went ahead and froze a number of Russian assets. So suddenly, what countries thought could not be violated, they discovered that could be easily violated, that their assets could be very well taken away quickly with the stroke of a pen. That started the movement away from the US dollar. Countries wanted to be sure that they could invest their country's treasuries in a manner that they could get it back whenever they want. That was a major moment of realization. And subsequently, what we had is the Make America Great Again movement, which resulted in a whole lot of tariffs being imposed on most countries. I would say not most, on all countries, at least a 10% and going up to 155 to 200% tariffs and what have you. Suddenly, there was a huge disruption in trade. And again, corporates are finding out that having manufacturing facilities in countries that who may not be friendly to the US is an Achilles heel. It is a vulnerability. And that again spawned a movement to have manufacturing facilities elsewhere. But this breakdown in trade is having multiple impacts, right? So you had, yes, the cost of goods likely to go up for Americans, but it has also resulted in, again, a loss of confidence in America. So you're finding that the primacy of US is now coming to an end. While it could retain its reserve currency status, it is not likely to be as politically powerful as it was earlier. Even if these tariffs get negotiated, we are seeing the end of a period where you had a unipolar world. You had an America going out there and protecting the rest of the world. So once you had Europe, the Eurozone, which depended so much on America for military support, they figured that they need to be on their own. It's another reset. So the world is no longer the same place that the alliances are being formed, new trade blocs are being formed, and old friends need not be old friends anymore. The crisis has seen traditionally held correlations amongst asset classes break down. When I say correlation, what do I mean? A correlation is if equities fall, then bonds go up. That's a traditional relationship. If interest rates are high, the value of gold comes down. That's a traditional relationship. None of these are happening. You are seeing high interest rates in the US, but also high gold prices. You are seeing high employment in the US, but also prospects of weak global growth. You're seeing bonds and equities go up and fall at the same time because of factors that we had not anticipated earlier. So all this makes us wonder what to do next. So global investors have been quite puzzled, and the first reaction for most global investors was to sell assets across the world and take it back to their home country, which is the US. So the initial part of this was you saw assets being sold, equities, bonds, etc., being sold in all parts of the world, and it went back to the dollar. And the dollar strengthened. We had the dollar index go up to 108 also, and even crossed 108 due to the demand for the dollar. But that was only temporary because soon the kind of damage with the tariffs caused or likely to cause came out, and investors realized that it may not be the best of ideas to leave their investments in dollar, and they had to reallocate elsewhere. Where was the entire issue? We are seeing consumer sentiment in the US at a low. There is a lot of worry as to what could be the impact of tariffs on the nation. There is a worry that US could go into a slowdown or a recession. But why would that happen? One of the primary reasons could be that the consumer demand in the US could come down. The entire American economy is built on consumption. And if Americans feel insecure about their incomes, they're going to clamp down on consumption. Consumer sentiment is also already at a low. So you're likely to see, or a good possibility, that consumers would clamp down on their purchases, which could lead to a slowdown. This is one of the outcomes that the government is actually looking for to get a hold on inflation. The IMF in its recent survey has declared that global growth will be lower. Initially, it was 3.5%, but post the tariff being declared, they're thinking global growth will come down to about 2.8%, which is, pretty low. So what does one do? Let us take a quick look at what's been happening to different investment classes over the last few years. Okay. This is what's called an asset class quilt. All the green squares represent equities of different countries. The yellow represent bonds or bond related, and the reds are alternatives like infrastructure, commodities, or real estate investment trusts. So you'll see that each calendar year, it's been a different block that has been up there. It is never consistent. For example, 2019 was a year for US equities and 2020 was a year for Chinese equities. At the bottom of 2019 was cash and the bottom of 2020 was commodities. So there is no constancy here. If you're looking at what happened in 24, it was US equities right at the top. In fact, US equities have been having a dream run last few years. Okay. And we have seen that US equities as a proportion of global stock market capitalization had moved up from 40% to almost 70% at the peak in 2023. It started moving down only after 2024. So the US has been in a kind of a dream bull run, and which seems to be ending now. Okay. It seems to be ending because there is a sudden lack of demand for US stocks or US bonds for that matter, or any US for that matter. While US is the largest economy in the world, the largest consumer in the world, there is a worry as to what could happen to its economy in the future. So we had seen 2024 with US equities running 25%, a resurgence in China with a 19.7%, okay, and commodities at 18.4%. It seems that all the three were returning very well, emerging markets, commodities, and US equities. But 2025, the end of 2024 changed all that, and 2025 we are seeing a marked decline in US equities and China, both for the same reason. And we have an unlikely winner on top there, which is Europe. Okay. And while for 23-24, emerging market equities as a group have not been figuring in the top, but India as a market in dollar terms is right there on the top 2 or top 3 for the last 2 to 3 years. Okay, it's something to be noted. So here I'm looking at a chart which gives you the calendar year returns of different countries' equities alone. So as we saw, 2024 was led by the US, but the year to date, 2025, we are seeing European countries on top, UK, and Europe ex-UK at 5.82% way down the chart. But this is actually hiding what Germany has done. If one were to look at the German stock market alone, it is right there on top at 20%. It surpasses UK, it surpasses China, it surpasses EM, Japan, everything else. So we are seeing that recognition that, number one, Europe was having very low valuations, but that wasn't it. It was a major change in the Eurozone fiscal strategy. It was started by Germany. Germany, after a long time, said we are going to spend more to pump up our economy and to spend to loosen our fiscal purse strings, borrow more, and stimulate economy. This was quite unheard of in the last few years, and the scale of the fiscal deficit which Germany is willing to incur to help stimulate its economy, and then through that the entire Eurozone, is amazing. And not just the German spending, the realization of Europe that they cannot depend on the US as a military ally as much as they could earlier, which meant that they had to spend more on their own defense. The estimate is that Europe will be having to spend at least 500 billion euros on defense. And that means a huge boost to the European defense industry. And we are seeing that as a trend in the near term and in the medium term. And this could probably stimulate the entire European economy. And that is what defense tends to do, because it has implications across a number of manufacturing categories, right? From steel to electronics to avionics and so on and so forth. But you'll see that the 10-year CAGR, the 10-year compounded return, the US stands right on top, followed by India. These are all in dollar terms, my friends. If US returned 12.4%, India returned 8.1% in dollar terms, which is number 2 there. Pretty good. It comes as a surprise to many that the Indian stock markets could do so well in dollar terms. I'd like to quickly run through the valuations of different parts of the world. The price earning ratio is something that many of us like to see it to determine whether a stock or a market is undervalued or fairly valued or overvalued. The top half of the slide shows you this. The blue line for each country's graph is the 15-year average, and the entire bar is a 15-year range. The green dot is where we are with reference to historical averages. For example, the S&P 500, which is the second bar from the left, shows that the 21.6% price earning ratio is way above the 15-year average. It's closer to the top. Whereas Europe says that the current situation is closer to the 15-year average at 13.2 price earning multiple. And if you're looking at China, also similarly at averages, and the average is at actually the lower end of the range, which shows that China, if in any other time, would be treated as a huge value buy. But given the political uncertainties, given the impact of a trade war between US and China, you will find that there's stocks as they in the future. But in the short term, there's a lot of uncertainty that could be driving it. India, you see, is at 22.8 price earning multiples, which is above average. Okay, so this kind of higher price earning multiple that is being given to India could be a result of the optimism that its growth rate could be far higher than other countries, and which is a fact. Even with the kind of tariff impact, India would continue to enjoy a higher GDP growth rate than most other parts of the world, which is why you will find that investors will give a premium to Indian stocks, which is a point in its favor. Other large economies like Japan and Korea are seeing subdued valuations across, as you can see. A little bit on gold. Gold has been the star performer in the last couple of years. Okay. In 2023 alone, gold rose up 12.8%. In 2024, it went up 26%. And in the year to date, it has gone up 22.6%, which is way above any stock market, any of the stock markets. Okay. Silver also did a pretty good job. So why doesn't one entirely go ahead and buy gold for their portfolio? Why take the risk of stocks? Why not have an asset which has been doing double of the S&P 500, double the Nifty? The simple fact is gold's performance has not always been a straight line up. There have been long periods where it did nothing or it lost a lot of money. So we should not get caught up in the recency bias just based on the last 3-4 years of performance and go pile into gold regardless of what newspaper headlines may scream at you. The table on the right actually shows you periods when gold did nothing. For example, in the 1980s and the 1990s, in USD terms, gold was minus 22%, minus 28%. And there have been periods for 20 years at a stretch, gold did not perform. Strangely, we do not find the same happening in India for the same commodity gold. The reason is rupee has always been a depreciating asset against the dollar, because of which we have always had a higher value for gold, and we did not see such drawdowns or such periods of stagnancy in INR terms as we saw in the dollar terms. Okay, so this is something you can keep in mind as a global Indian. So gold saw a run up recently because investors and central banks across the world have been wanting to move away from the US dollar. And gold is coming about as a neutral currency, which they can store and control. And thousands of tons of gold is being bought by central banks across the world, mostly in the emerging market countries, the developing countries, the global south, because they are the ones who are more worried about their assets in the US getting frozen for any reason. And this kind of phobia is spreading and more countries are buying up gold. But gold has seen such a parabolic rise. It stands to reason that one be cautious about adding more gold to their portfolios. After such a steep rise, you could possibly see steep corrections for whatever reason. All it needs is a trigger. You can just imagine if tomorrow the US and China arrived at a reasonable solution for the trade war, what happens to uncertainty? Just imagine for an instant that the conflict in Europe came down and Ukraine and Russia stopped the war. That would mean the uncertainty comes down. In such a time, the demand for gold would definitely not be as high as it is now. And even you should keep in mind that 1/3 of gold supplies is used for jewelry. And at such high prices, the demand for jewelry is falling across the world. Even in India, if you're looking at the large listed companies like Tanishq or Kalyan, they're all reporting lesser volume of gold being sold. So we should bear in mind that there are risks even with gold. Interest rates, because when you're putting money in a bank deposit, when you're buying a bond, you need to be mindful of what's happening to interest rates across the world. We've seen a very volatile period as far as global interest rates go, especially the developed world. Emerging markets have not seen such a volatile interest rate scenario over the last few years. And you will find that those who have been holding US treasuries for the last, say, 5 years, 6 years, have not really seen good returns on their US bonds. And they've even lost money for long periods of time. The projection is that US would reduce interest rates going forward because inflation is coming down. But inflation is a little stubborn. And we are seeing that jobs are still strong. There's no pain on the street, which means that you may not see as many interest rate cuts as earlier anticipated. We do think that if the US enters a slowdown or a recession, that would surely be a signal for the Fed to cut interest rates. The European Central Bank, on the other hand, has been cutting interest rates. We've seen their inflation fall below target levels, and they would now want to be stimulating demand and recovery of the economy. In India, also, we've started seeing interest rate cuts. For a long time, we thought we wouldn't cut because we needed to support the Indian currency versus the dollar. But now with inflation coming well under control and the scenario changing, the RBI has begun to cut rates and have a more accommodative monetary policy. And to stimulate growth, I'm sure we will see more interest rate cuts by the Reserve Bank of India in India. So how does one position a portfolio in such a situation? Okay, let's look at what different countries how they are positioned in the tariff scenario. So this graph shows you how much a country is exposed to the USA. If it is exporting a lot to the US, you'll see a large gray band. If it is exporting more to the EU, you'll see blue. And if it is China, if it's a dependency on China, you'll see red. So wherever you have a large exposure to US on trade, you are going to see a slowdown because demand will come down as exports from these countries become more expensive for Americans. So these trade barriers are going to have an impact on countries which are dependent on US. So you will see that countries like Mexico and Canada have a huge dependence on America. And if the tariffs continue the way they are, you could see these countries go through difficult times. Broadly, you will find that it is the emerging market countries that have a greater dependence on the US. Specifically, if you see India, it does not have as much a dependence on US as some of the other countries as far as its exports, composition of exports go. It has an even balance in that sense. So if you're looking to go and invest, you're probably looking for a country which has a lower dependence on America or lower dependence on China, because in a trade war, China is also going to get impacted. So we are seeing here on this chart, how much could the GDP be impacted because of the trade war? And again, you are seeing that those countries which have a greater exposure to the US, okay, are going to see. As far as India is concerned, we are not looking at more than a 0.5%, 3.3 to 0.4%, though this chart shows a higher percentage. The latest IMF estimates and the RBI estimates show that India may not be impacted as much on the GDP front as was feared. It may be 0.2, 0.3%. The reason being that India has got a very, very large domestic economy, and we are not as dependent on exports as one may think. A large amount of our exports are services, and the services are not impacted by tariffs. Maybe they're equally split. Out of the total exports, half is merchandise and half is services. So that's why we do think that India is better positioned in all this than many other countries. So here is a chart, my friends, which shows the returns of different asset classes in dollar terms over the 1, 3, 5, 10-year period. Okay, and starts with emerging market bonds, then US Treasuries, FCNR deposits, gold, NRE deposits, Indian debt funds, and the Nifty and S&P 500. Okay, of course, we've spoken about gold. We can see that gold in green has been the top performer, but since you can't have all your wealth in gold, you need to be looking at others, and then you get an idea of what's happening. Bank deposits to many are a great source of security, but if you're looking at the NRE fixed deposit, after compensating for the rupee depreciation, it has not really been a great source of wealth generation. The FCNR deposit is better because it's dollar denominated or sterling denominated. Here we are representing the dollar denominated FCNR. So as long as the rupee is in a depreciating mode, any rupee assets may not be so good unless the return is much higher than the rate of depreciation. And that is why NRE FDs did not do well. But we do think that the rupee may not be depreciating at the same rate as we thought earlier. That is because we should understand that one reason for a currency depreciating is the higher inflation in that country as against US. And today we are seeing the inflation differential between the US and India come to a much, much narrower band. And if it is in that situation, the rupee is bound to depreciate much lesser. And actually, if you're going to see an attraction for FDI or FII in India, as it has been seen in the last 2 months, you will see that the demand for rupee go up, and just the flows can also impact the rupee strength. So you have a lower inflation differential and foreign inflows coming in, which could keep the currency up. And again, a current account deficit, a trade balance would all be much, much better looking if the dollar is weaker, as we have been seeing. So you holding rupee as going to be such a great idea, a bad idea as it was earlier thought of. We are having a far better economy. We are seeing better currency strength, and all these point to India definitely competing for investors' eyes. Okay, and right there on top. So this is a chart of different kinds of assets, whether it is cash, developed market equities, global high yield bonds, Asian bonds, EM debt, US debt, global bonds, again, all kinds of equity and debt assets. And here again, what I'm trying to show is that there's no particular asset which is always ruling the roost. The best way to treat your portfolio is to diversify across all these assets. And today we really don't know who's going to be doing better, who's going to be the winner. And the best solution is to diversify. Okay. And here I just wanted to show you that if you had an asset allocation which had a mix of all assets, then you are not going to be like a rocket, but you're also not going to be at the bottom of the sea like a sinker. You're going to be floating, and that is a way to survive. And that is a way to build wealth without taking too much risk. Okay. Sorry. As just to summarize all that I have said, my friends, the principles which you need to be following clearly are asset allocation. Don't keep all your assets in one country or in one asset class. You need to be thinking of diversifying your portfolio across different countries, not just the US. The US is no longer going to be the best place to remain invested. I'm not saying that the stock markets are going to be bad. In the near term, yes, we don't know. But in the long term, the US being the largest economy will hold its strength. But you should be looking at Europe, you should be looking at India, you should be looking at other countries also, especially where they're not as dependent on the US. Apart from equities, look at bonds. Interest rates in India with lower depreciation are more attractive. Yields in Indian debt funds are anywhere around 7.25%. And if the rupee is not going to be depreciating as much, it's an attractive place. FCNR deposits are attractive. You need to be having some hard assets because you do not know which way inflation is going. If you do not know what is going to be causing chaos in the future, you need to have some hard assets like gold and silver also in your portfolio. While gold has shot up a lot, maybe silver is not looking as expensive. Okay, but in any case, both are volatile assets, and don't expect that if you have them, it's going to be a one-way ride up. It is going to be swinging, and you'd better be having a stomach for it. And that is one reason why you should not have too much of it either. So equities, bonds, hard assets all need to find place along with a huge dose of caution. How do you deal with it? If you want to be invested in these asset classes, the other trick to do is keep investing over time, like a systematic investment plan or a dollar averaging type of plan, but don't try to get into the market at one shot. I mean, we saw a relief rally in stock markets across the world. But what's going to happen after 90 days? I don't know. And Believe you me, nobody knows. So if you think the trouble is past, no, hold on to your horses, wait for these 90 days, see what happens. So diversify geographically, diversify across asset classes, and diversify across time if you want to survive this chaotic bit that we've all been thrown into. Okay. That's all from me, folks. So questions, if you have any, welcome.
Yeah. Yeah, thanks, Shrikant. Shrikant, there was some issue on the network. So I think, yeah, once in a while it cuts, but I think, yeah, it was great. I mean, I'm requesting all the participants to pose questions to Shrikant on the chat. I will curate and share those questions to Shrikant in the real time. Looking forward for the questions.
Oh, I'm sorry. I'm just seeing the messages now. So
yeah, no problem, Shrikant. We understand. Nag, I hope I communicated the message. I hope my yeah, I think I see a yeah. Shrikant, there is a question on probability of US revaluing gold on its books.
yeah. So this has been like a conspiracy theory going around, Vinod. And the theory has been that if it's able to revalue its gold reserves, and that could be used to borrow more money. Could happen, but it is not the reason for gold price going up. If gold price is going up, this could be an opportunity for US to reduce its fiscal deficit. Quite could happen.
Yeah. Next question, I think Ish, I think somebody was trying, I think somebody is texting.
So today we had the Berkshire Hathaway annual conference, and a lot of people have been listening to the sage of Omaha.
Yeah.
He seems pretty concerned too, though he doesn't say things directly. So he has voiced concerns about the strength of the US dollar. And for the first time, he says, yeah, maybe we should be looking at owning other currencies. Okay. Yes, he is worried.
Yeah, Shrikant, the next couple of questions. Do gold prices in different countries matter? And before that, there was a question on what are your present thoughts on investing in Indian real estate? So two different questions, Shrikant. Yeah.
Sure. So let me take the one on the real estate first from Kumar. That is the order. So, Kumar, real estate has been a good investment in India, broadly speaking. And cities like Bangalore, Bombay, and Delhi have generally been doing well on the real estate front. The problems with real estate are like this. One, you need a large sum of money to buy real estate. Okay. And second, administering it and maintaining it. So if you're an NRI, you need to be having a strong support system back home in India to help you manage and administer the real estate. Whether you have to find a tenant or pay taxes or ensure there's no encroachment and no legal issues and things like that. Otherwise, real estate always forms a part of the asset allocation pie. Because of its illiquidity, again, you need to balance yourself and not have too much real estate. There's also the concept that buying apartments is as good as buying real estate. But buying an apartment is like buying a manufactured good, and there's depreciation at some point of time. So it can never be a great real estate investment if you have an apartment. Okay, it's good to stay in. Even the rental yields on an apartment are hardly 2%. So I never consider an apartment as a good real estate investment. A site, a commercial property, these are good real estate investments.
Yeah, the next question is on the gold price, Shrikant, investing in
Yes.
different countries. Yeah.
Yes. Hi, Ashwin. So gold prices in different countries, it can differ. Okay. For example, the gold price in India for the last few years used to be higher than the international gold prices because there's a 15% duty on gold in India. So if there are customs duties or tariffs, gold prices could vary in different countries. Yeah. So if you've been buying gold at a higher price because of some kinds of duties, then you know it's an artificially inflated price to that extent. If the duties are withdrawn, the local price of gold will fall. So we used to be careful in India to that extent because we were aware that we were 15% higher than what it should be because of customs duties. So the Middle East doesn't have any duties. So gold price is the lowest there.
And the view on Goldman Sachs house view on the gold, Shrikant, I think there's a question on view on house view of Goldman Sachs, right? 375.
Right. I see that question. Now, Goldman Sachs or any of the large houses are only going to be serving their own interest when they put out reports. Let us remember that. And the reports have not always been on the dot. It could be a lag, it could be late. So one really doesn't know how much higher gold will go. We are at $3,200 an ounce and we're facing some resistance. The last 2-3 days, we've seen some slip up in gold futures by 2 to 3%. When they sort of saw that US and China could come to the negotiating table. So there are too many moving parts here. And anything could upset the price of gold, either down or it could take it further up if the chaos goes on. So anything from here is a risk. There's a probability of it moving both the ways. So Vinod, I really do not have an answer to you on that. There's too much uncertainty on that.
Shrikant, the next question is on invest in Dubai real estate, right? I mean, from India to Dubai now.
So Dubai has a unique position as a place where people from across the world come, especially troubled countries in Africa and the Middle East and Asia. They feel Dubai is a safe place. So a lot of money goes to Dubai and gets invested there. And in any case, Dubai also has been promoting itself as a financial destination, as a tourist destination, and there's been a good demand for real estate for Dubai in the last few years. So yes, it could be an option.
The next question, Shrikant, does India have potential to become the next global hub for manufacturing, similar to China, right? So what's your view? Yeah, India becoming
Yes, good question. Good question from Neetu Jain on that. India has always had a lot of potential for a lot of things. And we've been only breathing potential. We've been surviving on potential, but not all the potential has got converted. But today, we have a massive opportunity on our table. And I'm just hoping that we are able to swallow and chew on this entire opportunity. And this opportunity is to become that global manufacturing hub. So I don't think we can become as good as China, as efficient as China. But from where we are, I do have high confidence that we are going to be manufacturing a lot more goods than what we are doing today. The percentage of manufacturing to the GDP is very low for a country like India. And I see that it can easily double or more. Services has taken over. Earlier, it used to be manufacturing, agriculture, and then services. Today, services is a larger component of our GDP. And manufacturing, there's a very good chance it will go way higher than where we are. Yes, it's a good place to be in as far as India is concerned.
Shrikant, the next question, Nag himself posted on behalf of Vasu. So with India being at a pivotal point to focus on growth from non-service, that's IT, should we expect a rapid depreciation, right? And any thoughts on what depreciations have? It's on the currency, Shrikant.
Right. Yeah, I understand. So India historically has been depreciating at the rate of about 4.5% per annum, largely because of the higher inflation that we used to run as compared to the US. And today, since we are able to control our inflation far better, we would be depreciating at a lower rate. But let us also understand that if you're looking at the RER, then India is overvalued. The Indian rupee is overvalued, and it is more of a political thing about currency strength. Actually, if we were able to depreciate more, we would be able to be more competitive on exports. But because of this political overhang that we have to keep our currency strong, it is impacting. I'm thinking eventually good sense will overcome all this, and you will see that the rupee will be allowed to depreciate more. The RBI is also open to it now based on what we have been seeing over the last few months with the new governor in place. We are seeing new thoughts. And if we want to be an effective exporter of manufactured goods, yes, we should allow our rupee to depreciate more. But this would be a fine balance. It's against a dollar or against other countries. Okay. So vis-a-vis the dollar, we may not depreciate as much. Vis-a-vis other nations like the euro, we may depreciate. It's quite possible.
Shrikant, the next question is about Middle East, right? Similar to the Dubai, right? The question is similar to Dubai, any other countries or currencies that might be similar, having similar advantage?
Yeah, I'm just reading this. Middle East tends to have benefited from foreign money flow as they are now diversifying their income streams and are considered relatively stable and safe economies. Any other countries or currencies that might see similar advantages? I am assuming that you're talking about stable economies.
No, no, it could be any country. For example, Saudi Arabia, example I'm saying that you may have similar to Dubai, right? Middle East. Are there any other locations, geography where it could help, right? I mean, which could raise to the
Yeah.
occasion?
So the kind of we are seeing the developed countries not being able to invest as much in their economies because of the large fiscal deficits that they have run up, whether it is Europe or USA. So you're going to see more of this happening actually in the developing world, the emerging market world. Harsha, you mentioned Saudi Arabia, and Saudi is actually going to see a hell lot of development. It's already on the way to its new development plan. Okay, and you're going to see a lot of capex happening there. And apart from that, I'm not seeing which other countries could benefit in the immediate term.
Okay.
India is going to be a shining example, believe me. Because of its non-aligned position, because of its potential, because of the demographics, you're going to see a lot of attention coming into India unless we do something to score a self-goal. Otherwise, yes, India is going to be that other country.
So moving to the next question, Shrikant, do you recommend investing in crypto?
See, I may be biased, Vinod, but till I find a fundamental strength and a fundamental justification for an asset, I would not recommend buying it. Now, crypto has no fundamental justification. It is not regulated by any country. Unless you have something like a stable coin coming up, which is backed by the US dollar or some other currency or regulated by a central bank, I would not go in for crypto.
I think Shrikant, we should keep it in last 1 or 2 questions because I have few more slides to present. You will have to bear with me. Yeah, we'll read through the next couple of questions. Getting ROI based on appreciation and rentals over 20% in Dubai, upcoming Emirates, Ajman, and I think the similar question, right? I mean,
Yes.
I think, we discussed this. We'll move on to the next one. for NRIs in the current scenario, is it better to keep our savings in a US bank account versus an NRO, considering the current decrease?
Yes,
Yeah, it's a good one.
that's a good question from Mr. Kumar. You may actually have to be alive to the position of having your assets in a depreciating currency when you're in the dollar. Okay, but in any case, looking at the kind of higher interest rates that India has to offer and a relatively stable currency, you may be better off investing in Indian FCNR deposits or any kind of Indian bonds. It is not a bad idea. It may do you well. A US bank account doesn't fetch you much interest unless you're buying a money market fund or a US treasury. A US bank account is, I would not at all recommend keeping money in a bank account. Okay. Because you will hardly get a percent. So rather have it in a money market fund in the US or a short-term treasury, or yes, an Indian FCNR deposit is good.
Shrikant, thank you. I think I am sure we'll get more opportunity, Vinod, in future to speak to Shrikant, and I would be taking few minutes, Nag, and then I'll hand it over to you. Just thank you, Shrikant. Yeah, so I'm sharing my screen now. Just let me know whether you can see my. Yeah, we had a small quiz. I'll answer this. I posed this question. I mean, most of them, when we didn't get the right answer, I'll move on. So from data points, I'm deliberately showing a movie on a Saturday, right? When I was a college student, when I watched movies, it was car was a cynosure, right? I mean, I always watched movies only for the cars, right? So we saw, I mean, I'm sure most of you know this picture and this, right? But today, that was once upon a time. But today, if you look at it, car is no longer an exclusive because you have Uber Lux. You have a fantastic holiday home, great villa, you have Airbnb. But if you look at private banking, right, certainly still is in the paper maps era, because just having a Robinhood or a Wealthfront doesn't equate to private banking, right? And then if you look from your perspective, right, when I look from an NRI perspective, on the left-hand side, if HNI, which is I'm taking 10 million, greater than 10 million assets, investable assets, the HNI or a UHNI, ultra HNI, HNI is high net worth individual, has a full suit wealth service, right? When I say full suit, she has an access to a banker, broking, alternatives, taxation, real estate, credit strategy, insurance, and inheritance. All of them comes on a platter. Whereas on the right-hand side, you are all affluence, right? But still, if you look at it, you have multiple, it's one to many, right? You need to independently talk to a tax expert, and there is a huge price tag, investments with multiple wealth tech platforms, you will have insurance coming in, retirement. So it's definitely a piecemeal wealth service, right? And so to solve that problem, we have InvestMates, right? Which currently, as we have, it's solving most of your problem because it's a unified wealth dashboard, taking care of both US as well as India assets. You can do real-time wealth tracking, and you should experience and see, right? So when I talk to my NRI friends, generally there is a delay of looking at a new product, right? So what's the hidden cost of going it alone, right? On the left-hand side, it's a very powerful chart. I'll take a half a minute to explain. There's a company called Dalbar. Most of them are not aware of it. What it does is it compares the investment return versus investor return. I repeat, investment return versus investor return. That means S&P 500 in last 30 years has given 9.7%, right? Year CAGR. Shrikant showed so many charts. They're all investment return. But your return may not be that much because an average DIY investor is significantly lower than what the investment return has given. Like, for example, I broke down and put what does it mean for you, right? Assuming that your annual investment amount you may be saving $10,000 per year for 30 years. If you are taken independently, right, that DIY's do-it-yourself approach, your value after 30 years, it will be 0.91 million, right? Whereas if you had tracked the index, not doing DIY, you would have made 1.55, right? Technically, if you look at it, such a small amount, look at the impact, you are losing almost 0.6 million, right? The point is that even in India, whether it's across the globe, investment return always is higher than the investor return. So therefore, talking to an expert is very useful. On the right-hand side is a taxation, right? It's a screenshot from IRS data book, where it says that most of the immigrants in US, right, miss out the F bar. Some of my friends didn't even know what is F bar. And look at the impact, right? F bar and other foreign asset form penalties has significantly increased in the last couple of years. So, there have been many stories you might have heard. So therefore, talking to a tax expert as an investment expert is very, very useful, which will save money, right? So, and I'll pause on InvestMates. Thank you for participating in today's webinar. As a token of our gratitude, we have included some of exclusive gifts for you just for today. So it's there. It's a 30% discount on the pro subscription fee as well as premium subscription fee. And you will have one advisory call free of charge if you subscribe today. Please use the code. The key takeaway is IMR2A, right? If you can download the app and then you can visit the website, you will be able to download here. So thank you. And please do, if you have any quick questions, you can post it on chat. Coming back to the quiz, this company is called Compass, which is a listed entity in UK FTSE, right? Most of you might have seen the catering business. It's a catering business, right? It's a company called Compass, which is listed in UK. So I'll pause here. Thank you, Nag, for giving the opportunity. Thank you, team Remit2Any, for giving this opportunity. And over to you, Nag.
Thank you very much, Srikanth and Harsha, Prakash, everybody, for the insightful and engagement session. So you have walked us through the broad and meaningful view of the market, where you have the global market, tariff implications, and also the traditional safe havens like a gold and USD to INR dynamics and everything. So yeah, your clear expectations of NRE and FCNR deposits, I think that is very important for as an NRI myself. So we especially value, I think it's very valuable for our NRI community. So at Remit2Any, our mission is to goes beyond moving the money. So we aim to empower the users to make confident and more informed decisions for the financial future. So today our session is aligned with that vision, and thank you for the InvestMates for making this possible. And then once again, thank you, Srikanth, for your time. Thank you, everyone.
Most welcome. My pleasure to be with all of you.
Yes. And first, finally, I would like to thank everyone who joined today. We deeply appreciate your for taking time to be part of this conversation. So have a good morning, afternoon, and evening. Thank you.
Thank you. Okay. Bye.
Bye-bye.
Bye.